Hello there, savvy investors and financial enthusiasts. Today we dive into a topic that's both incredibly relevant and potentially profitable: the 5 best ETFs that will make you rich in a recession. In the world of investing, navigating the stormy seas of a recession can be a daunting task. But fear not, as we're about to explore a safe harbor that could potentially turn the tides in your favor: exchange-traded funds, or ETFs for short. These financial vessels offer a diversified portfolio in a single trade, making them a smart choice for those looking to weather economic downturns. ETFs allow you to spread your investment across multiple sectors, reducing your risk while opening doors to potential profits. Today we're focusing on 5 ETFs that have shown resilience during tough economic times: IAUM, BIL, SCHD, VDC, and FUTY. So buckle up as we delve into the world of ETFs and uncover those golden opportunities that could potentially make you rich during a recession. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. Before we dive into our top 5, it's crucial to understand what an ETF is and why it's a smart choice in a recession. ETF is an abbreviation for exchange-traded fund. It's a type of investment fund and exchange-traded product traded on stock exchanges. ETFs hold assets such as stocks, bonds, or commodities, and they aim to keep trading close to the net asset value of their underlying assets. Now, why are ETFs a smart choice, especially in a recession? There are a few reasons. First, ETFs offer diversification. When we say diversification, we mean spreading your investments across various assets to reduce risk. Instead of putting all your eggs in one basket, you spread them out. In the context of ETFs, instead of buying shares in just one company, you're buying a small piece of an entire sector or even the whole market. This diversification can help protect your investments from the adverse effects of a recession. Second, ETFs offer liquidity. Because they're traded on stock exchanges, you can buy and sell ETFs just like individual stocks throughout the trading day. This liquidity can be particularly useful in a recession when you might need to adjust your portfolio quickly in response to changing market conditions. Third, ETFs are generally more cost-effective than mutual funds. They typically have lower expense ratios, which means they can be cheaper to own over the long term. In a recession, when every penny counts, this cost-effectiveness can make a significant difference. Lastly, ETFs allow for risk management. You can use ETFs to hedge against potential losses in other parts of your portfolio. For example, you could invest in an ETF that tracks the performance of a sector you expect to do well in a recession, offsetting potential losses elsewhere. Now that we've got the basics down, it's time to dive into our top 5 recession-proof ETFs. First up on our list is IAUM, or iShares Gold Trust. A shining beacon in the world of ETFs, IAUM is a fund that focuses entirely on gold. Now you may be thinking, why gold? Well, let's delve into that. Gold has long been considered a safe haven asset. This means that in times of economic uncertainty or turbulence, investors often flock to gold as a store of value. It has this unique ability to hold its value, even when other markets are seeing a downturn. So, what's the deal with IAUM? This fund offers exposure to the day-to-day movement of the price of gold bullion. It does this by holding gold bars in a secure vault, which are then represented by shares in the fund. This way, investors can gain access to the gold market without the need to buy, store, and insure physical gold. Convenient, right? Now let's talk performance. During the last recession, gold saw an impressive rally as investors sought safety amidst the market turmoil. And IAUM, being a gold-focused ETF, was right there to capture that surge. This fund has demonstrated a strong track record of performance during economic downturns, making it a potentially smart choice for those looking to shield their portfolios from recessionary winds. But it's not just about performance. IAUM also offers liquidity, meaning you can buy or sell your shares in the fund whenever the market is open. This provides flexibility, allowing you to adjust your position as market conditions change. Of course, like any investment, IAUM comes with its own set of risks. The price of gold can be volatile, and there's no guarantee that it will rise during a recession. However, its historical performance and safe haven status make it a compelling choice for those looking to hedge against economic uncertainty. So, if you're looking for a safe haven during turbulent times, IAUM might just be the golden ticket you're looking for. Next on our list is BIL, or the Spider Bloomberg Barclays 1 to 3 month T-bill ETF. This financial instrument is quite the mouthful, but don't let that intimidate you. BIL is an exchange-traded fund that focuses on short-term treasury bills, specifically those with a maturity of between 1 and 3 months. So, what does this mean for you as an investor? Well, when it comes to BIL, it's all about stability. Treasury bills are backed by the full faith and credit of the U.S. government, making them one of the most secure investments you can make. This is particularly important during a recession, when market volatility can make other types of investments much riskier. But BIL isn't just about playing it safe, it also offers a reliable return on investment. While the returns may not be as high as some other riskier investments, they are steady and predictable. This makes BIL a great choice for risk-averse investors or those who are looking to balance out a portfolio with some higher-risk assets. BIL also has the advantage of being highly liquid. This means you can buy or sell shares in the fund at any time during the trading day, at whatever the current price is. This flexibility can be a significant advantage, especially during a recession when market conditions can change rapidly. But perhaps the most compelling reason to consider BIL is its track record. During the last recession, BIL outperformed many other types of investments, maintaining its value while others plummeted. This resilience is a testament to the fund's focus on stability and security, qualities that are particularly valuable during turbulent economic times. In conclusion, BIL isn't about chasing the highest possible returns, it's about preserving your wealth even during a recession and providing a steady, reliable return on investment. With BIL, you're not trying to hit a home run, you're playing the long game. And in the world of investing, that can often be the smartest play. With BIL, you're looking at a stable, low-risk investment that can weather the storm of a recession. Moving on, we have SCHD, or the Schwab U.S. Dividend Equity ETF. This is an intriguing ETF that focuses on high-dividend, large-cap U.S. stocks. These are companies that have a market capitalization of $10 billion or more, which means they're some of the biggest and most stable businesses in the country. So what makes SCHD stand out? Well, let's dive a little deeper. The primary allure of SCHD is its concentration on high dividend-yielding stocks. This means that the companies in this ETF are known for paying out a significant portion of their earnings to shareholders in the form of dividends. This is a fantastic feature for investors who are focused on income, as it provides a consistent stream of cash flow even during economic downturns. So, how does SCHD perform during recessions? Historically, high-dividend, large-cap stocks have shown resilience during economic downturns. This is largely due to their robust business models and their ability to generate steady revenue even when the economy is facing challenges. As a result, SCHD has demonstrated a strong track record of maintaining its value and providing consistent income during recessions. But why choose SCHD over other high-dividend ETFs? The answer lies in its diverse portfolio. SCHD holds shares in over 100 different companies spread across various sectors like technology, healthcare, and consumer goods. This diversification helps to mitigate risk and provides a safety net during volatile market conditions. Moreover, SCHD has a low expense ratio, making it a cost-effective choice for investors. It's also worth noting that SCHD's dividend yield has historically been higher than the average of the S&P 500. This means that SCHD's dividends could potentially provide a higher income than many other ETFs. In conclusion, if you're an income-focused investor looking for a resilient and reliable ETF for your portfolio, SCHD could be a great choice. With its focus on high-dividend, large-cap U.S. stocks and its proven performance during recessions, SCHD offers a promising combination of stability and income potential. If you're after consistent income during a recession, SCHD could be your best ally. Fourth on our list is VDC, the Vanguard Consumer Staples ETF. This is an exchange-traded fund that focuses on a specific sector of the economy, namely consumer staples. This sector includes companies that produce or distribute everyday items like food, beverages, and household goods. Now, you might be wondering, why consumer staples? Well, the answer lies in their nature. These goods are considered essential, meaning they're in constant demand regardless of the economic climate. This is why, during economic downturns when many sectors struggle, consumer staples often remain resilient. VDC, therefore, offers an attractive proposition for defensive investors. By investing in this ETF, you're essentially investing in a collection of companies that historically have shown resilience during tough economic times. It's like having a safety net for your portfolio. The Vanguard Consumer Staples ETF is managed by one of the most reputable ETF providers, Vanguard. This means that it's not just any ETF, it's a fund managed by a group known for their meticulous selection process and rigorous risk management. But what's more interesting about VDC is its composition. The ETF is largely composed of large-cap companies, meaning these are well-established firms with a history of stable earnings. This adds another layer of security to your investment. Remember, in a recession, stability is king. Furthermore, VDC has a low expense ratio, which is a significant advantage for long-term investors. In the world of investing, every penny saved in fees is a penny earned in returns. But like any investment, VDC isn't without risks. The performance of the ETF is directly tied to the performance of the consumer staples sector. If this sector faces challenges, the ETF could suffer. However, given the essential nature of consumer staples, these risks are generally considered lower compared to other sectors. In conclusion, VDC offers a blend of stability, resilience, and low fees, making it a compelling choice for those looking to defend their portfolio against the ravages of a recession. In a recession, VDC could be the defensive play that keeps your portfolio in the green. Finally, we have FUTY, or the Fidelity MSCI Utilities Index ETF. Now you might wonder, what makes FUTY so special? Well, let's dive right into it. FUTY is an ETF that is focused on utility companies. These are the companies that provide us with basic necessities such as electricity, gas, and water. These services are essential and people continue to use them regardless of how the economy is performing. This is why utility companies, and by extension FUTY, tend to be stable even during recessions. FUTY follows the MSCI USA IMI Utilities Index, which includes companies from various sectors like electricity, gas, water, and multi-utilities. The ETF provides exposure to a wide range of utility companies in the United States, making it a diversified investment option. Now let's talk about why FUTY might be a good choice for conservative investors. First, it's a low-cost fund. With an expense ratio of just 0.08%, it's one of the cheapest utility ETFs available. Low cost can have a significant impact on your returns over the long term. Second, the nature of utility companies makes FUTY a defensive play. As I mentioned earlier, people still need to pay their utility bills even during a recession. This means that utility companies and in turn FUTY can provide a steady stream of income when other sectors are struggling. Third, FUTY offers a decent yield. As of now, it has a dividend yield of about 3%. This can provide a steady stream of income, which can be especially valuable during a recession when other sources of income might be dwindling. To wrap it up, FUTY is a low-cost defensive ETF that provides exposure to a range of utility companies. It offers stability and a steady return, making it a suitable choice for conservative investors, especially during a recession. If you're seeking stability and steady returns during a recession, FUTY might be the right choice for you. There you have it, folks. Those are our top 5 ETFs that could potentially make you rich during a recession. Let's take a moment to recap. We started with IAUM, a gold-backed ETF that can act as a hedge against market volatility. Then we moved on to BIL, a short-term treasury ETF, known for its stability during economic downturns. Following BIL, we explored SCHD, a high-dividend ETF. This one is particularly attractive for those seeking regular income streams, even when the market is not in their favor. Then we delved into VDC, a consumer staples ETF. We like this one because, recession or not, people still need to buy their everyday essentials. Last but not least, we discussed FUTY, a utilities ETF. This one is a favorite among investors during a recession, as utilities are considered a safe bet when other sectors are struggling. Now remember, while these ETFs offer promising opportunities, it's vital to keep in mind the importance of diversification and risk management. No single investment should make up the entirety of your portfolio. It's always wise to spread your investments across different assets to minimize risk. Also, it's imperative to do your own research. While we've provided a starting point, it's up to you to dig deeper. Look into the performance history of these ETFs, their management teams, and their investment strategies. Knowledge is power, especially in the world of investing. And remember, investing isn't a get-rich-quick scheme. It takes time, patience, and informed decision-making. So stay curious, stay informed, and keep exploring different investment avenues. Remember, the key to successful investing is informed decision-making. So like this video, subscribe to our channel, and share this knowledge with your friends. Here's to making smart investments even in a recession.